Hello, everyone. Welcome. I'm Connor Kitko. I'm joined today by my colleague, friend, and fellow director, Rushi Shah, Director of Product Management here at YCharts. How are you doing, Rushi?
I'm doing well, Connor. Happy Cinco de Mayo. I feel like we do these webinars sometimes on holidays, and the last one was on one. So hope you're doing well as well.
Yeah, I think the last one may have been like a real bank holiday, which was a little bit of a misstep on our part, but here celebrating Cinco de Mayo, as you said. So every quarter, we review the latest economic update deck, which is a resource that we make for our clients and everyone in our community to use. The visuals and the data will be summarizing the first quarter of 2022. And our hope is that it can help you navigate this current pullback that we're facing in the equity market. Clients of YCharts can access this deck by logging into their accounts, and I'll show you really quickly how to do that. So if you hover over support in the top navigation and then click support topics, click on resources, and then over here on the left, you'll see economic summary deck. And here you can access the latest presentation and historical ones as well. If you are not a client and you want a little bit of a stripped down version of this deck, which is free to use, just head over to ycharts.com and there's a very recent blog post there where you can get a link to that abridged version of the deck. Two final reminders before we jump into the meat of today. Number one, nearly all of this data that we're reviewing was published by different government agencies in the last couple weeks. As of the end of Q1 2022. And we will be emailing a recording of today's webinar to everyone who registered and attended. So if you're looking for that recording, no worries. It will probably be hitting your inbox tomorrow. And now I'm going to pass things off to Rushi to get into the data.
All right. Well, thanks, Connor. And thanks for everyone for joining today. I know it's a crazy time in the market, so let's jump right into the data from Q1 and review some of the notable parts of that first quarter. So that econ summary deck, like Connor mentioned, it's all these slides, and we start off with the key stock market index performance, just to give you an overview of what was going on. Pretty red all around for all 6 of these major market indices. So you're looking at the US markets in that top chart. You can see the Dow, S&P 500, and the Nasdaq Composite all fell, greater than 4%, with the Nasdaq Composite actually falling nearly 9%. So quite the drawdown there in Q1. I was just looking at some notable names and why Nasdaq has fallen more than the other indices. Just to name a few of those big mega cap stocks, like Facebook falling 33%. Nvidia falling 7.2%, Google, Apple, Amazon also all negative. It just kind of shows like some of those mega caps that have a large percentage in that composite index were really dragged down the index as a whole. And just want to kind of plug your webinar for next week as well, that goes into a little more detail with those mega caps and what they're causing in these major market indices, which kind of explains why the Nasdaq was down almost double in comparison to those other 2 indices.
Yeah, exactly. We are going to be speaking with Michael Batnick, and it is interesting how, post COVID-19, really it was those mega cap, large caps driving that resurgence in the S&P. And now things are turning around where they're down worse than the index and a lot of other constituents. So I know we just shared that link in the Q&A. If you are interested in joining myself and Michael Batnick next week, we'd love to see you.
Cool. Yeah, and then just kind of moving on to the global markets here, the MSCI indices, MSCI World, the EAFE, and also the emerging markets all down more than 4.5% as well. So red all around here for the key market indexes. And then drilling a little deeper into the actual US stock sectors, pretty crazy to see the energy sector here up about, 39% in Q1. So a lot of news around Russia and supply constraints and a lot of things going on with the oil markets, causing the XLE ETF just to grow by 39% in Q1. Wasn't really the same story for the other sectors. So you're seeing the only other positive sector was the utilities ETF. So that was up about 4.7%. But communication services was down the most. And like we talked about a little bit in the last slide, technology was down 8.5%, and consumer discretionary was also down a little more than 9%. So pretty interesting quarter for individual sectors as well.
Great. Yeah, so we're going to move on from sectors now, and I'll talk a little bit about asset classes. So this table, or a quilt as we sometimes call it, shows the performance of different asset classes over a few different look back periods. And since this is data as of March 31st, 2022, you'll notice that the year to date and 3-month total return columns are showing the same data. The top of this table has remained pretty consistent over these increasingly larger lookbacks. Commodities returned 33.1% in Q1. However, the rightmost column here showing that 10-year total return indicates that commodities are just slightly below even going back to 2012. So pretty isolated uptick for commodities just in the last quarter. US growth was hit the hardest in Q1 2022. It's at the bottom of this table at -9% down here. And there has been some recent hope for equity holders, though, with emerging markets being the sole equity category with negative return in March. And the S&P 500 was up 3.7% in March. However, now we know getting into April, things have turned south once again. But there was that slight reprieve going into the end of Q2. Now I'll move on to some of the similar data, just slicing it in a different way. So we're looking at quarterly asset class performance over the last 15 quarters. Commodities, again, is on top after falling behind in Q4 of 2021. And as the only positive asset class of Q1 being commodities, everything else down anywhere from 0.7% for US value to -9% for US growth. And yeah, again, the picture has just turned really sour for growth stocks and those riskier asset classes as things like inflation and interest rates and geopolitical pressures are taking hold. A lot of those, those discounted cash flows are just getting discounted even further. And a lot of these names have seen slowed growth as well. And such is the nature. If you can't maintain those high growth rates, then you can't really justify those high prices for some of these stocks.
Yeah, so I can cover this slide, Connor, and this is talking through the performance of diversified portfolios. So we actually use our model portfolios tool to create this chart, and you can see the allocations of the 3 different risk models on the right side there. And it basically tells the story of, the more diversified you are, or the more conservative your risk tolerance is, your drawdowns might be less, but also you might gain less performance over time as well. So you can see this chart goes back about a year, and the S&P 500 as a whole is up the most, but it also had a 12.8% drawdown in Q1. So it was down the most, but you have the most return, kind of that risk reward trade-off. But you can also look at some of the other risk profiles here. You could see that conservative one where you're basically all 80% in fixed income was actually negative over the last year. And a lot of that is attributed to some of those fixed income ETFs or fixed income in general also having a negative Q1 as well.
Yeah, I was looking at something earlier, Rushi. I think even like AGG is down almost 9% through the first quarter. So very interesting, or as of, through April. So very interesting just to see nothing is really working in some of those diversified portfolios right now.
Yeah, definitely. Interesting times.
Interesting is one way to put it. Okay, moving on along to bonds and interest rates, next section of our deck here. And we'll focus on this interest rate summary. So the first quarter of 2022 did bring a lot of action to the yield curve. Treasury rates really rose across the board, and by so much in the short end of the curve, looking at those 1 year to 10-year maturities, that the yield curve has flattened to the point of inversion. So it was a temporary and brief inversion. I think that happened on April 1st. But in the beginning of April, we saw that inversion. And now with rates increasing and some action from the Fed, that 10 to 2 yield spread has widened to become positive again. But we also saw some negative GDP. So we'll see what really is in store for the economy. Back to interest rates, the 5-year Treasury rate ended Q1 at 2.42%. I believe that's up close to 3% as of today. And that was greater than the 10 years rate of 2.32% yield and just shy of the 30 years 2.44%. And so this is perhaps that bellwether of slowed economic growth. And we'll be watching very attentively what the Fed's moves really implicate for the market going forward.
Yeah, I think all of us are aware of the increase that Powell made yesterday, and so it'll be interesting to see how this yield curve changes next quarter as well.
Absolutely, and Rushi and I were just talking about this before the webinar, but such exuberance on that news, and maybe even trust in Jerome Powell and the rest of the Fed oversight board. But then looking into today, as soon as the markets open, all of that trust and faith in the Fed seem to have gone away.
Yeah.
Okay, moving on to some macro data, and I'll pass it to Rushi to talk about some of this.
Yeah, so this is basically a heat map visual of, on the left side, you have about 5 quarters. So Q1 of 2022 and the 4 previous quarters before that. And then after that, it switches to annual numbers. So these are basically leading indicators that you want to keep an eye on if you're looking at the economy in general. And some really notable numbers came in for Q1 of 22. The first one is that 10-2 Treasury yield spread. A lot of people talk about that as being a big leading indicator for telling you if a recession is looming. And it's gotten pretty close to inverting, like Connor kind of mentioned on that yield curve chart right before this slide. And so we're at about 0.04. And if you look back in history, you could see that we actually hit that inversion back in late 2019, early 2020 as well. So that's one to probably keep an eye on. The other one in here that I found pretty interesting was consumer sentiment. It's actually the lowest value on this visual. And I was looking back, I don't think we've had a number that low of 59.4 since 2012. And before that, it was right before the financial crisis. So consumer sentiment is pretty low right now. You can kind of analyze that the way you want, but it's interesting how we have these different dynamics and how the consumers feel, how much they have in savings, how much they're spending, housing prices, all of that bundled up is telling a pretty interesting story right now. So those were the 2 glaring ones that I noticed on this visual. The other one, just some of those housing numbers like housing starts and building permits still look pretty strong, still green on this visual and increasing in comparison to the previous quarters. So that'll be another one to keep an eye on and to see if that continues as mortgage rates increase.
Yeah, and really quick, if I can jump in, Rushi, the interesting thing about that consumer sentiment number is, as you noted, it's dropping and rapidly, but not shown here is another of our economic indicators on YCharts, consumer spending, which is really seeing the opposite right now. So it's kind of an interesting question of, yeah, the sentiment, consumers aren't feeling good, but we're still going out and spending money and making purchases. So what does that really say about the economy going forward? Your intentions versus your actions. Who knows?
All right. So this slide is also pretty interesting as of late. So this is showing us trade balance, and you're seeing these two charts at the top. The one in the top left is basically giving you the US exports and imports of goods and services. And then the one on the right is giving you that net number of what's the net trade balance on those goods and services. So we're seeing that continue to increase. And we're now above that 2020 level, which is pretty interesting. However, the net trade balance for the US is at its lowest level ever. So if you look at the chart on the right, we're at that negative 228 billion in net exports, which is pretty insane that it's increasing like that. And then also at the bottom, you have the exports and imports of different regions, and you're seeing pretty much green across the board in comparison to last year, which is kind of makes sense with everything being shut down with the pandemic, and now things are reopening. So you're seeing a lot more going on with trade in general.
Yeah, very interesting to continue seeing this number slide lower. And we've seen before that it has potential to snap back, but it took a global pandemic to swing that number in the U.S. favor. But again, we'll see what happens going forward and if that deficit continues to widen. We'll talk a little bit about some housing market data, and Rushi called this out a couple slides previously, but the beginning of 2021 saw the lowest 30-year mortgage rate on record, not on record, but in recent memory, along with the highest number of mortgage originations. And that's great news for a lot of people who could take advantage of that low rate. Since then, mortgage rates have headed higher and quickly, which has also led mortgage originations to decrease in response. So in addition, with refinances cooling off and a strong housing market in terms of prices, refinances are now accounting for 53% of mortgage originations, whereas it was north of 70% as of Q1 of last year. Moving on to some US dollar strength, definitely impacted by that relationship between the imports and exports, but the US dollar to the euro, the pound sterling, and to the Japanese yen exchange have all increased to 52-week highs in the first quarter. Great to see for the purchasing power of the US dollar. However, looking up to this top chart, a little bit more of a domestic picture, that ICE US dollar index in green is increasing, but as the consumer price index moves up as well, the purchasing power of that dollar domestically is still on the decline. So again, if you're traveling abroad or if you yourself are importing something, then perhaps that's good, but the situation here at home is still not necessarily improving for consumers and spenders. Okay, charts of the moment, getting into some of the more interesting trends that we've seen in the economy and in the market over the last quarter. And I'm going to turn this one to Rushi for, I think, one of the wackier charts that we've got in the deck.
Yeah, definitely. And I love this section because we get to, our team here gets to look at basically everything on YCharts and look at some of the most interesting stuff going on. And this one is pretty amazing. So with everything going on in Q1 with the war in Russia and Ukraine, it's been causing some interesting just basically market environments in general. And so this chart here talks about the markets, and it shows the Russian ruble to US dollar exchange rate, which basically went south right after that war happened. You're thinking about, the Russian markets falling 30% immediately right when that war was announced. Just a lot going on there, and it caused that currency to also crash in general. On the right is something else that's really interesting. So the Russian markets were closed for 1 month. However, US ETFs that are trading Russian stocks have to stay open because they're traded on our markets. And so it was really interesting to look at the discount and premium to NAV for these ETFs. So there's two ETFs we have on this chart. One's the iShares MSCI Russia ETF, and then the other one is the VanEck Russia. And you can see how these charts almost, I don't want to say don't make sense, but you're basically pricing them off of something you don't really know because you don't know the true value of the assets in those ETFs. And so just to show you where to find this data within YCharts, because I think it's pretty cool. For any fund within the tool, you can actually access the discount or premium to NAV. So in that top search bar, Connor, if you want to just go ahead and search like that VanEck Russia ETF. And if you go to that data tab, you can actually search discount or premium to NAV. There you go. And now you can see that historical value. So still really interesting. You could see how the value was pretty much at zero until everything that happened. And now it's at 1.61,000%. So still a little bit of a wacky situation here, but something interesting to watch with some of these ETFs and the Russian market in general. Something else I wanted to actually plug right now too is a cool enhancement we added with our portfolios. So if you actually go to a portfolio and if you're an advisor talking to clients and you want to talk about Russia in general and show allocations, we actually now break out country exposures. So Connor here is on one of his model portfolios and he's on the allocation tab. And if you expand those larger regions, if you have an actual exposure to one of those countries in those holdings, you'll actually be able to see. So this portfolio has 0% in Russia. So maybe you want to have a conversation with your clients and say, hey, we're keeping you away from Russia exposure for now with everything going on. Here's how it looks from a country exposure standpoint. So kind of a cool little thing we added here because we know a lot of advisors are having that conversation with their clients right now.
Yeah, really great to see this breakout. And yeah, just another way we heard the request from users and advisors, and we want to make sure that we're giving you the tools to answer those questions. So there you have it, added to YCharts. I will take a quick second to answer a couple questions that came through. Someone asked why look at the 10-2 spread and not the 10-3. I'm assuming that's a 10-year to 3-month spread, which is another one that very much recently or in the last decade has become another popular recession indicator. And yeah, the reason for that we focus on the 10-2 is just that that's historically a really great or a strong predictor of recessions, but recognizing too that the 10-year to 3-month spread is also an accurate indicator as well. One more question, the best way to view yield curves in YCharts, is it necessary to build it in the Excel add-in? So I do want to show that in our Excel add-in template library. So if you're using the add-in and you don't want to go through this work yourself, there is a yield curve template in here, Treasury yield curve. And if I preview it, that's pretty much exactly what we just looked at in our slides. However, if you just want to look at this underlying data behind the yield curve, hover over data in your nav bar and then click on economic indicators. And this page is actually another recent enhancement, this great heat map, and you can look into the different countries very easily. But I'll scroll down to in our category section, there's this interest rates category of our econ data. And in here, this is all sourced from the Federal Reserve, and you can see some really great interest rates for a ton of different countries. And then here is some yield curve rates for the US and everything that kind of goes into that yield curve. And there's that 10-year to 3-month spread that we were just discussing as well. So awesome to see. If you do want to build that curve yourself, two options: Excel or coming into the data on the front end of YCharts. Steven, the 90-day is actually the most accurate, believe it or not. Predicted 14 of the 10. Okay, great insight. I will definitely check that out. I'm sure we have that data in YCharts. So we'll definitely look into that, Steven, because yeah, it's always which indicator do you look at, which one do you trust and put your faith in is definitely going to be a something that's going to determine if you make the right move or maybe not the best one at that time. Okay, back to the deck now. So here looking at a chart of retail gas prices, US retail gas prices hit an all-time high of $4.41 per gallon in Q1 of 2022. And this is a national average. I believe that in places like California, this is even higher. And we do have some of those indicators in YCharts too, if you want to see this state by state. But this is topping that previous high that we saw back in 2008. And prices are up 45.3% over the last year alone. Now, I myself am a bit of a city boy. I don't have a car and thus no gas tank to fill up. So looking at this data really always catches me off guard because I don't personally, feel the effect in my own spending. But it is shocking to me just to see how rapidly the price can move and make these huge swings. And to that point, gas prices, energy costs are a very big contributor to something that Rushi is going to talk about next, which is inflation.
Yeah, thanks, Connor. And good time to have your bike out, right, and save that money on the gas. But yeah, this chart, speaking of things getting more expensive, the U.S. inflation rate, it's been pretty phenomenal or just unbelievable how much inflation has grown in the last few months, last year or so, and we're up to over 8% in that U.S. inflation rate, which going back to about like the 1980s, that's the last time we've seen this type of inflationary environment. Really interesting to see how the Fed's dealing with it, how the consumer's dealing with it as well. And I don't know, Connor, if you have your inflation hedges in, but it seems like a lot of investors are looking at potential other investments other than stocks to get into some hedges. But I did want to plug our stocks page a little bit too for this section, because I think it's related to just looking at different stocks, and it's not necessarily related to inflation, but you can look at stocks and sectors as a whole. And maybe you are looking for a sector that's held well during inflationary environments. You can go to the stock page, and actually, if you scroll to the bottom of this, you'll notice that you can change the time frame to year to date. And we talked about how energy has been the green spotlight for the first part of the year, and some of those other sectors are not doing as hot. So maybe you are looking for that inflation hedge, and this is a good place to start. And you can click into those sectors as well to do some deeper dive into those sectors and industries in general. So just wanted to show that for you YCharts power users that like looking at some visuals on the tool.
Yeah, this has been a huge addition to the platform, Rushi, and specifically for that, seeing what's lighting up green. It's like watching the opening board, whenever the market opens on CNBC. So really cool to see what's lifting an index or holding it back, and same thing for the sectors.
Yeah, definitely.
Okay, on to the next here, talking about the interest rate hike. So the 2-year, 5, 10, and 20-year rates have all risen now as of present day into that 2% yield territory. And I think some are now actually cresting 3%. And we mentioned again that 10 to 2 spread briefly inverted, and a few other spreads also inverted. Just yesterday, we've talked about this, the Fed announced that 0.5% rate hike, which is a little unusual compared to the usual 25 basis point moves that they announce. And again, we talked about this, but the market at first responded very positively, and now not so much. The big question here is, can the Fed continue to raise rates, bring inflation within control, and not have any adverse effects for economic growth or corporate earnings or any of those things that eventually feed into GDP numbers? So we saw that GDP, we had one negative growth over the last quarter, and 2 quarters of negative GDP growth would equal a recession by definition. Rising inflation plus a recession, stagflation, everyone's favorite scary word. But I did want to show in YCharts really quick, specifically those Fed rates. So we're looking at interest rates right here. But if I go over to this chart that I created before we all joined, you'll see that I have the target federal funds rate upper limit. I also have the lower limit and the effective federal funds rate, what we're really seeing in the market. So you see now that the upper and lower limits are at 1% and 0.75% respectively. And that effective rate is going to eventually climb up into that range as we have seen historically. So rapid moves, and we'll see what it really has, what kind of effect it has on the stock market in particular. Again, initial very exuberant response after those meeting minutes were shared yesterday, and then now today, if you've seen how the market opened and how it's doing through lunch, not very good. So we'll see what happens.
All right, and then we'll just close out with one more chart here with just overall mixed coronavirus data. So if you're not familiar, we have coronavirus data on YCharts. So you can look at different things like cases per day, hospitalizations per day, deaths per day. And you can also look at that for different countries, but also different states. And we knew that advisors are having these conversations, and they're keeping an eye on this as they're trying to gauge what the market's doing and what individual companies are doing as well. So just overall, just general charts on the US, it looks like the trends are showing that the latest strains, like cases might be increasing, but hospitalizations and deaths in general haven't increased at the same pace, which is a positive in general. So something that probably doesn't hit the headlines as much nowadays with the war and everything else going on, but something that advisors are definitely still keeping an eye on.
Yeah. And we do have a few questions that have come through that we can take. If anyone wants to hang around and get some more insights about YCharts or about this data, one person asked about yield data for municipal bonds or indices in YCharts. Rushi, is that something you can talk us through?
Yeah, we do have a few muni indicators. The best way I would recommend is just kind of searching for them. We also have some indices. I believe we have like the Bloomberg Muni Index, if I'm correct. Yeah, the Muni Bond Index. This is a good one. We usually recommend people to look at when they're looking at the muni markets in general. We don't have individual like actual fixed income bond data, but we do have some good indices and indicators to gauge that market as well.
Yeah. Another question from Michael that came through. This is a good idea. Getting an interim economic deck prior to the quarter end would be great information. This is something that we always try to get this data out as soon as possible. The quarter end info usually comes out around 2 weeks after the quarter actually ends. But that's a great suggestion. We'll always do our best to try to get this in everyone's hands as fast as possible.
Yeah, Connor, just to add one small thing there, what we can do, and I know a lot of this data is already in there, but we have templates on our fundamental charting tool. So for example, if you're trying to look at some economic data in the middle of a quarter and you just want to look at the chart, you can go to that template section, and we have some of these pre-canned and ready to go. So as you open them, they're showing you the most updated data. For example, yeah, something like mortgage rates or intraday yield data, things like that we have pre-canned, but we can definitely add some of the ones that we usually add in the econ summary deck.
Yeah, that's a great suggestion. Unemployment breakdown, another good one. Yeah. Francisco asking about making that interest rate hike chart. I will assume that you're referring to this one we just looked at. And sure, I can just reset this really quickly. And when it comes to adding econ data to a fundamental chart and YCharts, you're still going to use that securities field. So I'll just say federal funds rate, and you see that target Fed rate upper limit. And then I'll just say lower limit for the lower. And finally, we added the effective federal funds rate. With all three of those on my chart, now I can play with the time frames and kind of show over different look backs what that trend really looks like. So if that helps you out. Trisha, can you show how to access the coronavirus data? Absolutely. So again, probably type to search is one of the fastest ways that you can get here. If I just say coronavirus, you see all of these things that automatically populate for me. But if you go into data in your navigation bar and then click on economic indicators, once in here, down here is this categories and our reports information. And one of these will show us coronavirus. I'll click view all, go to C, and here we go, Center for Disease Control and Prevention. I can click on this as a source, or I can click into this data set in particular. So once I do this, now we see everything that we are getting from the CDC as a source. And it's a great way to just stay on top of this information for different states and different countries as well, because we are getting some from, not from the CDC, but from other regulatory or government agencies around the world as well. Okay, Tom, calling out, yeah, we were looking at a total return index for the muni bonds, looking at municipal bond yields in particular. Let's see, here's some funds that might do the trick. And then what we can do is go and look at, for this fund in particular, look at its yield. And I believe that this will be showing, because it's a fund, we're using that dividend yield metric. And I believe that this is what people will be looking for. But if there are more questions about that, there are some people who are even more experts on our data and yield data here that would be happy to help you find exactly what you're looking for if this isn't doing the job. One final question from Peter. You got it, Tom. Thank you for that question. One question for Peter. Why does U.S. retail gas price only go back to 1995? Let's investigate really quickly. So really, it's probably just due to the data source and the availability of this data. We are getting this from the Energy Information Administration. The EIA is the main authoritative body on this kind of data. And when we go to them to collect and aggregate this for all of your use, I guess it just turns out that this is as far back as that historical view is being maintained right now. If you wanted to look at something like crude oil prices, WTI or Brent crude, I know that those indicators go much farther back into history. So you can see some of the, even crazier stuff from the 70s that was going on. Okay. I guess that's it. Rushi, any final remarks to close us down?
No, I think that's all. Thanks, Connor. And this was fun and looking forward to seeing next quarter's results as well.
All right. Thanks, everyone. And again, join me and Michael Batnick next week. We're talking about mega cap stocks and market weighted ETFs and mutual funds and how that picture for large caps is really impacting a lot of investor portfolios. So hope to see you there. Have a good afternoon, everyone.